Welcome back. If you're saving money, you've just heard some good news. And if you've got too much debt, sorry about that too. We've got with us two chief economists from the SA Institute of Race Relations, Ian Cruikshanks, and from FNB, Sizwe Ngqetlana. Now, gentlemen, the two of you have been discussing this off air just a moment ago. Brazil seems to be an example to us. I'll start with you, Sizwe.
Yes, so I think Brazil is a very good example of what can happen if you don't get ahead of monetary and fiscal policy risks. Brazil has a highly indebted government with a large current account and a budget deficit, and inflation on the rise, and the economy there is in recession. And to counter that situation, the Reserve Bank there is hiking interest rates aggressively, even as the economy is deep in recession. And the government is having to cut spending and raise taxes also very aggressively to try and rein in a situation which is not too dissimilar from what we're facing here in South Africa. So I think from that point of view, it's actually commendable that our policymakers, both fiscal and monetary, are trying to act before the fact to rein in these inflationary pressures and these budget deficits before the markets force us to.
That to me spells a change in the minds of the MPC. Last time they said, we will wait for Janet Yellen. Nobody's waiting for Janet. Yeah.
Yes, so what you could say is, who is she waiting for? We don't really know. But they did say it would be data dependent. And if we look at the data affecting the South African expectations of inflation, they are worsening, there's no doubt about that, because he put some emphasis on the biggest risk being the rand exchange rate. Although the oil price has come down, in dollar terms, in rand terms it has not, and in fact we've had two petrol price increases in the interim. We could expect another one, but that will be after this meeting. I think that he also put a lot of emphasis on the food prices and the drought, the maize and wheat crops and the devastation that they've been having in some areas. So, I think what it is, he was doing what they know on not necessarily historical data, but data expectations. And they're clearly getting ahead of the curve, which they can see worsening as an inflation outlook. And one has to say that is commendable. There's no doubt about it.
But now here's the thing that bothers me. We don't have inflation locally, at least not from demand side. Yet we're importing it from a disinflationary world. How does that make sense?
No, so that's not quite accurate. So inflation in South Africa is on the way up, right? First quarter of next year, you're going to see inflation very close to 7%.
But then what's driving that if we as consumers are not demanding goods?
It's cost push. So there's two sources of inflation. There's demand pull, that's too much money chasing too few goods, but there's also cost push inflation, right? That comes from, for example, significant increases in administered prices, both regulated and unregulated. It comes from a significant depreciation of the currency. It comes from wage inflation, which is hovering around 8%, when inflation has been closer to headline inflation has been closer to 5%. So all the input costs, despite demand being weak, are actually pushing headline inflation higher, and we will see headline inflation peak very close to 7% in Q1 next year. And the problem is that after that peak, when it does come down, it comes down and stays either just above 6% or just below 6%. And then you add the fact that the rand could depreciate even further, given that we are a small open economy with a large current account deficit, in an environment where the cost of funding that deficit is going to become difficult and push the rand up, that the risk to inflation after next year's peak is that it's even higher than where we think it is. So against that entire background, I think it's very prudent of the SARB to start acting to make sure that they push inflation to where they want it to be, which is within 3 to 6% on a sustainable basis.
But how is that going to happen, considering what you've just told us? It sounds to me as if the only way we will control inflation is by controlling the rand, and that seems to be the move here.
They've always made it quite clear that we cannot do that. But at least you can control to some extent or influence some of the factors which contribute to that. And I think number one, as we mentioned, was the current account deficit, and that obviously we're living beyond our means. We're importing more than we're exporting.
So why don't we stop?
Well, because literally we have to eat. We can't produce enough food to feed the country anymore. So this is a problem. It's going to be a very difficult, we're going to live in a discomfort zone for some time. And I think that has to be appreciated. And, if we have to look at other factors which have been, over which we don't have an immediate control, like electricity, for instance. We've been told we're going to have another 12% or more, could be double that, next year. It is impossible to bring other input prices down to compensate for that. So I think, as the governor said, we're in an rising inflationary cycle. Never mind what happens to the rest of the world being close to deflation. We have special circumstances which are beyond our control.
I'd also like to add to that question, and I think it's critical because there's always a misunderstanding between, if it's not demand pull inflation, yes, and it's cost push inflation, how does constraining domestic demand by hiking interest rates counter that? The issue becomes twofold. One is that if inflation is high for cost push reasons, but for an extended period of time, it starts to impact inflation expectations.
Second round.
Right? Second round. So it starts to get baked into the system. So businesses, for example, start thinking, well, inflation, the SARB wants it to be between 3 and 6. Inflation is 6+. And so they start budgeting on 6+.
Okay.
So you hike interest rates to penalize and to convince people that that is not the case, and you will fight that perception until someone yields, right? That's the first thing. The other thing is, if the risks to inflation are the exchange rate, and the exchange rate is at risk because our interest rate differential, in other words, us and the Fed. So the Fed hikes, and if we don't hike, then we could see some portfolio flows, then drip feeding some interest rate hikes to keep our assets, our fixed income assets, and therefore our exchange rate assets attractive, also can reduce those risks to the inflation outlook.
Okay. I'm a little bit more confused than before, but let's take a break. Maybe it'll clear up in the meantime, and we'll be back with more analysis.